finish this. Okay, so the derivative trades, there's two scenarios, although I did them backwards. The first one is what happens, given the table for derivative trades, you would recommend if you and your team are forecasting a 5 to 10% upward movement in the stock. That's this one. So if you were in the stock, the bond price, the oil price, the gold price, or the US dollar. So if you're forecasting the value of the prices to go up based on the indexes. Yeah, he's recording. Based on the indexes, you are going to buy forwards, buy futures, buy calls on futures, and write puts on futures. Forecasting the price to go up in the exchange traded funds. You can buy on margin, buy calls, and write puts. If you're forecasting the stock prices to go up, you're going to buy on margin, buy calls, and write puts. If you're forecasting the prices to go down, and again, these were the hedging trades we were applying in the portfolio model. If you're forecasting the stock index prices to go down, you're going to write forwards, write futures, write calls on futures, and buy puts on futures. If you're forecasting the exchange traded fund share prices to go down, you're going to sell short, write calls, and buy puts. If you're forecasting the stock prices to go down, you're going to sell short, write calls, and buy puts. And after the midterm, I'll come back and I'll walk you through a little bit more detail in the trades, in the derivatives. But that's all you need to know right now is basically the trades based on your price forecasts, either up or down. Technical analysis of the book that you're studying from is basically focused on fundamental analysis, or what's called fundamental analysis. There is also what is called technical analysis. And technical analysis is pretty straightforward. You all will be using and analyzing a lot of data and a lot of trends in the data. And basically technical analysis is looking at historical patterns in the data and looking for patterns to recognize from. And there's, in the technical research and technical analysis literature, there's momentum trading. So if stock prices are going up, they're probably going to continue to go up, particularly if you have stock volume. The volume of the purchases of those shares will continue to push the prices up even further.
So the bottom, like
This
where?
When you look at, when you go to stock charts and bigcharts.com, they will have some technical charts that will have the trading volume at the bottom, and then they will show you the price of the indexes, the ETFs, and the stocks.
Is that like fortune policy?
Yeah, exactly. So it's, in most cases, when stocks are in prices are in upward momentum, the volume is going to increase. Or when the stocks are selling off, and people are selling a lot, the volume is going to kick up. So the volume could kick up and push prices higher, or the volume could kick up and push prices lower. So this is the volume. Usually at the bottom you have the trading volume, where you have other types of technical indicators that show momentum. Historical price trends, you're looking at these price data going back in time. And usually you'll go back at least a couple weeks, maybe 2 months, 2 years, maybe 5 years, depending on what index or exchange traded fund or stock or whatever it is that you're tracking. So you're looking for historical time series and looking for patterns in the data. And you're trying to recognize and see if there's any patterns. And I'll take you through a technical analysis example. It's really time series analysis. You're also looking at trading volume. You can also also calculate moving averages in these prices, from these prices, to see how the current stock price is trading compared to historical averages. And then there's other, what are called wedge and flag patterns that I won't get into, that are other technical indicators that technical traders use to trade these securities. So here's an example of a technical chart, price chart. Let's say this could be any index, could be any exchange traded fund, could be any stock. So as you see, the stock price has moved up, hits this point, comes back down, bounces off the bottom, hits the point again, bounces off the bottom, starts to go up. This, when a stock is trading like this, when it hits the peak like this, that's called the resistance line. And when it bounces off the bottom like this, that's called the support line. Okay? And when you see a stock price break through, or break out to the upside, that basically indicates that the stock is in a new price pattern. There's some kind of news or some kind of event that caused it to break through this resistance line. Go ahead.
So like the breaking all this one is not in the same area, but it's in another?
Yeah, so all of a sudden it's broken. This set the resistance. For some reason, Apple Computer could not go above $200 per share. For some reason. But all of a sudden there was an earnings release that beat analyst expectations and caused the stock price to break out to the upside through the resistance zone. And then in most cases, the stock will trade again within a range, up and down. It will wait until news comes that will cause it to break up to the upside and or break out to the downside.
So when it reaches a new range,
Yeah.
is that top P part is also called the resistance?
Yeah, so this was the this was the support, original support. This was the resistance. Once it broke to the upside and started forming, it's called forming a bottom. Once it forms a bottom, that becomes the new support. And once it hits these tops like this, it just can't seem to break out. That forms the resistance, the new resistance.
Well, like, let's say we have this and there's a resistance and then it breaks off, but then it goes back to the same like range and never goes up. We just stay with
If
the.
it, like this, where it's kind of traded in this range, right here, that would be called a trading range. It's called a trading range. The stock just can't seem to break to the upside and is not breaking to the downside. It's in a trading range. It's also called a sideways pattern. It's trading sideways. It's also called the accumulation phase. So basically the stock is just trading within this range. It's accumulating over time, and it's basically waiting for some kind of news and volume and momentum to either cause it to go up to new highs or down to new lows. Okay? So as you can see, it traded sideways in this trading range for a while, and then it broke to the upside.
But since it came back down into that range, that one's still the trading range, right?
Yeah, it seems like for some reason it just can't seem to stay above,
Okay.
and seems to come back down and continue to trade in this range. And then obviously this could have been like some kind of negative earnings release or some kind of negative news that caused the stock price to break out to the downside.
So regardless if it's going up or down, you would call it breaking out?
Yeah, so it broke out,
Or, oh, so
Looks like
you
it
call it
broke out
upside
here.
or downside?
broke out here to a little bit, and then broke down, and then it really broke to the downside here, and it broke to the downside here. So something, this could have been like Yahoo stock. Yahoo just got hammered, trying to got bid up, do the merger talk, and then, it started crashing. And that's basically technical analysis. I'm not gonna get into it, but when you read the security news, when you hear about traders and analysts and portfolio managers talking about the securities in their portfolios, they're gonna conduct fundamental analysis and talk in that language, which is from your book, but they're also gonna be talking in these technical, analytical language. Okay? And they talk about resistance and supports, trading ranges and accumulations, and breakouts to the up and the downside based on some kind of news. Okay? And then the fundamental analysis, which is the intrinsic valuations, and we'll get into this after the quiz, is there's basically 4 intrinsic valuation models that you need to memorize. Everybody, hello, because I'm going to be talking perpetuity, I'm going to be talking Gordon growth, I'm going to be talking about the multiple approach and the discounted cash flow approach, and you got to know what it is. Okay, I don't want to get halfway through the semester and ask you what the risk-free rate is or what the perpetuity model is, and you don't know. Okay, so you need to memorize this. And the perpetuity model is pretty straightforward. It basically says if you're evaluating a bond, okay, or a stock, and the coupon on the bond, income that it pays as a dividend on the stock is being paid. So the cash flow could be dividends. If you're valuing a stock, could be earnings per share. It could also be EBIT, earnings before interest taxes, earnings before interest taxes, depreciation, and amortization, which is also called free cash flow. And that's on a per share basis. Then the theory basically states that the value of the security is the cash flow per share next year, okay, 1 year out, divided by the expected return on that security. So this discount rate can also be the expected return on the stock. And the risk-free rate is inside of this. Okay? So let's say I'm buying Apple stock, and I've calculated the free cash flow per share next year, and I expect at least a 10% rate of return on Apple stock. Okay? So if this is $10, and this is 10%, and the value of the share is $100. I'm expecting a 10% rate of return, and the free cash flow per share is going to be $10 next year. I take $10 divided by the 0.1, I'm going to get $100. That's the intrinsic value of the share using the perpetuity model. Now, if interest rates or expected returns go up, the value goes down. The expected return or interest rates go down, the values go up. Okay? Pretty straightforward. So the cash flows are the same. Now we're going to use Gordon growth. And this model also assumes that this cash flow is going to be constant. It will pay into perpetuity at a flat rate. So this model assumes that this cash flow is going to remain flat and constant forever. It's a perpetuity.
What does perpetuity mean?
Forever.
Okay.
It means that this cash flow, I'm going to get paid $10 a year forever. And the model basically states that that's all you do is take that cash flow that you're going to get and divide it by the expected return, and that's going to give you the value of the share. Okay? Based on the perpetuity model. Gordon growth basically states that we're going to assume that the cash flows are going to grow at a constant rate forever. not gonna be flat, but grow linear at a constant rate forever. So it basically states that you take your expected return and you subtract out the growth rate in which these cash flows are gonna grow at a constant rate forever. So this is gonna be a conservative valuation approach. This one's gonna assume constant growth in the cash flow. So again, if this is $10, right, and my expected return is 12%, then I think that the stock's cash flow is going to grow at 2% per year forever. Then this reduces to 0.1, and the value of the security is $100. So the key here is if this goes up, my expected return or interest rates go up, the value goes down. If the expected growth in the cash flow goes up, the value goes up. If the expected growth in the cash flow goes down, the value goes down. And if my expected return goes down, because interest rates are going down, then the values go up. So again, if this goes up, the value goes down. This goes down, the value goes up. Growth rates go up, values go up. Growth rates go down, the values go down. These are the basic valuation models that all traders and CFOs and CEOs and CIOs have in their brains. And they're constantly analyzing the marketplace, trying to figure out, are interest rates going to go up or down? And are our cash flows from our company going to grow at a faster or slower rate in the future? And it's going to impact the value of the security. The multiple approach basically takes the same cash flow and basically states that you multiply it in some price per share divided by the earnings per share, which is your price earnings multiple, the multiple. The multiple times the cash flow is going to give you the value of the security. So there's different ways of how analysts look at valuing stocks. Okay? They may use perpetuity, they may use growth, they may use the multiple one. Go ahead.
For the T plus one, is that like 1 year?
That's next year.
Oh,
That's next year. So when you're valuing stocks, you're not looking at the earnings today or the earnings yesterday. You are looking at what their earnings are going to be next year. Because current stock prices take into future expectations of earnings. It's forward looking. So in this case, if the multiple goes up, then the value goes up.
And the multiple is the.
It's the price of the share divided by the earnings per share next year. So if you want to value stocks, you take the estimated cash flow for next year, you take the estimated price earnings multiple for next year, you multiply them together to get the value of the stock. So if multiples go up, the value goes up. If the multiples go down, the values go down. And multiples are driven by growth rate expectations in the cash flows. So people think the company is going to, revenues or cash flows are going to grow in the future. The multiples are going to go up and the values are going to go up. People think that the company's growth in cash flows is going to go down. The multiple is going to go down and the value is going to go down. Okay. Did I answer? Okay. Then the last model that we're done is the discounted cash flow model, or what is also called DCF, okay, discounted cash flow. And you've already been working on discounting, right? You've discounted a bunch of cash flows in your homework and your exams, cash flows, discounting them back. That's basically the model. That basically states that the value of the security are the cash flows going out into the future, let's say 5 years. So you grow out the earnings per share for 5 years using the future value interest factors. Take those cash flows, divide them by the present value interest factors based on whatever return expectation you are, and you discount those cash flows back to the present. You not only discount the cash flows going out 5 years, but you're also going to discount the terminal value. Based on the last years, so if this is a 5-year holding period, you're going to estimate the terminal value, and you're going to discount that back by 1 plus I to the 5th power. The last cash flow that you get here, t plus 5, is going to be 5. So then the last year of your holding period, you're going to get not only the terminal value or residual value of the stock, the value in which you could sell it at, plus the cash flow in the last year, and you're going to discount that all back to the present to get the value of the security. Now this model is the most important model because I can value stocks, I can value companies, I can value other types of cash flow instruments, and then I can also do capital budgeting out of it and calculate present values. And we'll get into that after the quiz. The net present values and internal rates of return. So this is what they're looking for from you when you leave here. Can you model cash flows and discount them to the present to get the present value? And then subtract out the cost of whatever it is you're buying, calculate the net present value. If your net present value is positive, you're going to buy it. If it's negative, you're not going to buy it. Okay? And I'll get into more details in that stuff in the second half of the class, or second third of the class. Okay? So that's it. And,
One quick question.
Yeah.
For the first model,
yeah, there's some perpetuity.
as the,
You can turn off the video, please. Thank you.